Welcome to the Childcare Genius podcast, proud to be the world's #1 community for brilliant childcare leaders. Each episode will feature interviews with the brightest minds in the childcare industry to guide you into becoming a smarter business leader. Our hosts have opened 10 schools while raising 5 children. They are certified business coaches and are the top-selling childcare business book authors of all time. This episode is sponsored by Elif Childcare Insurance. Give Blake a call at 972-232-2258 to get a free quote on childcare business insurance today. Let's welcome to the Childcare Genius podcast our hosts, Brian and Carol Dupre.
Welcome to episode 69 of the Childcare Genius podcast.
We're your hosts, Brian and Carol Dupre.
Carol's a little bit, her voice is a little froggy today, so I'm going to do most of the talking, but she would say I do most of the talking anyway, so not much going to change. We've got a great episode in store for you today. It's end of the year tax planning time, so we're going to be having a great special guest talking about taxes. But before we do, just want to remind you, we have a Black Friday sale going on, and we've extended that through the end of the year. So tickets are now on sale for Childcare Genius Live Conference in Las Vegas, April 14th, 15th, and 16th. The most advanced childcare conference in the world. Content you're not going to hear anywhere else in any conference, with no sales pitches. All of our speakers are professors and adjunct professors. There's going to be no outside speakers. Nobody could buy their way onto our stage and try to pitch you anything because we don't have sales pitches. And we're going to have some poolside networking coaching. Tickets are on sale. It's on sale right now for $4.99 for owners, $3.99 for directors on our Black Friday special through the end of the year. And visit childcaregenius.com to purchase your tickets. And what you're going to find out today is get those tickets purchased by the end of the year. You can get that tax deduction, get those hotels paid for before the end of the year, and increase your tax deduction for sure. So today's guest on our podcast is Darren Hall. Darren has been doing my taxes and Carol's taxes for 25 years, and he's literally made us millions of dollars with amazing tax strategy and advice that we've gotten. We do an end of the year tax strategy call with him every December, spend an hour to 2 hours, really planning out what our end of the year tax strategy is. We make sure that we get every possible deduction we need to take to make sure our income is where we need it to be to optimize paying taxes. We plan what purchases to make end of the year, and we actually do a little bit of 2020 or next year planning, whatever year it is, but we'll do some 2024 planning as well on that phone calls. We've done that for many, many years. He does that for many of our Childcare Genius University clients as well, does the end of the year tax planning. So he's literally amazing. So we want to get to it, and I hope you take some notes because he's going to talk about something on this podcast that you're not going to hear anywhere else, and it's kind of eye-opening. Some things you're going to learn. So it's going to be a good podcast.
Let's get Darren on the line.
Hey, Darren, welcome back to the Childcare Genius podcast. How you doing today?
Hey, I'm doing great, Brian. It's great to be here. Good to see you.
Hey,
and
good
Carol.
to have you. Carol's voice is a little froggy today, so I'm going to do most of the talking, but Carol would say I do most of the talking anyway, so she's going to think nothing's different than normal. But we wanted to have you on. You're on our faculty. You're a Childcare Genius adjunct professor. You're a tax expert. You've been doing my personal taxes, my corporate taxes for over 25 years. And boy, time flies, doesn't it, Darren?
It sure does. Sure does. Seems like just yesterday.
Yeah, no kidding. So at the end of the year, for the last 20 something years, at the end in December, we always meet and we plan to make sure we have the best strategy going forward to the end of the year. And we also plan for the next year. And I wanted to take that same logic into the podcast for our followers, which we have thousands of them. And they all, like me, don't like to pay a lot of tax. You want to pay our fair share, but not a penny more. So we wanted to bring you on to kind of give some end of the year tax tips. So I guess we'll just I'm going to throw it to you to kind of leave it open. And if I'm sure you have a list of some end of the year tax tips that people could do in 2023 before the end of the year to help them out.
Sure. And the first thing I always talk with people about is do you want to, increase your deductions or reduce your income this year as opposed to next year? And I know a lot of people in the childcare industry this year still have grant money that's come in and their income is a lot higher. So they're all looking for ways this year to increase their deductions, reduce their taxable income, and push income essentially into next year where they'll be in a lower tax bracket, hopefully.
Now, I'm glad you said that, Darren. Before you go any further, because you got it spot on. And Darren knows the childcare business very well. He does a lot of childcare business tax return, and most of the grant money is ending in 23. Some states go into 24, but more than likely your income is going to be higher in 23 than in 24 for most childcare owners because of the grant money. So you definitely want to kick as much deductions as you can. So that's a good strategy, Darren. So all right, back to you.
Yeah. So with that assumption that's a good strategy for you to reduce your income this year, one of the easiest thing to do is to prepay some expenses. Pay all of your, assuming you're a cash basis taxpayer, which again most small businesses are, prepay expenses. Pay your insurances all ahead you can pay anything up to a year in advance, and still take the deduction in the current year. If you go more than a year in advance, you have to capitalize that. But anything up to a year, you can pay all those expenses in advance. Write your CPA a check to pay for doing next year's taxes, before the end of the year. Any business expense that you have that the people will accept your money early, that's great. So one way, prepay all your expenses. That reduces your income this year. Obviously, it's going to increase it next year because you're not going to pay those expenses and deduct them next year unless you do the same thing at the end of next year. Any needed assets for your business, anything that you need to purchase, make those purchases before the end of the year. So I always tell people, don't go buy something that you don't really need just to get the tax deduction. But if there's a big purchase that you've been looking at making, by all means, make it before December 31. You can still get 80% bonus depreciation. So 80% of the amount that you spend, you can deduct in the first year. And with Section 179, you could even still deduct 100% of it. Another good strategy is trying to figure out ways to defer income. So, you might do a program where you tell everybody, you tell all of your really, really, really good clients, hey, you know what? For the month of December, we're going to let you not pay, and we're going to let you pay, double in January, or pay 1.5 times your normal in January and February. So we're going to let you have some extra income in December. We're going to let you keep all your money in December and get free childcare, and then pay extra for it in January and February. That would push all of that income out of this year into 2024. Of course, you want to make sure that you're not doing that with everybody, because you certainly don't want people to take a month worth of free daycare and then leave. But that kind of thing is an option. Any money that's going to be owed to you, any money that you're going to have coming into your business, that you can say, hey, you know what? I'm going to give you the benefit of not paying that until January. When in reality, what you're doing is you're deferring it into next year. You don't have the option, if the person, hands you a check, and you've actually got it, and you hand it back to them and say, no, don't give it to me. You can't collect a check from them and hold on to it and deposit it January 1st. If you're doing that, you're breaking the tax rules. Once you have it in your hands, even if you don't deposit it in the bank, it's still income that you received this year. But those payments that come in December 31st, it's really difficult for anybody really to say that you received it on that day. It's an honor thing. Do you want to do the right thing? Do you want to cheat? And I prefer to tell people not to cheat. Let's see, what else can we do? Assuming most of you are a pass-through entity, which means an S corporation or a partnership, an LLC that's taxed as an S corporation or a partnership, or even just a sole proprietor. All of your tax is going to be paid at the personal level, not at the business level. So for you, there are other things that you can do at the personal level to reduce your taxes. One of the big things, if you've got investments, if you have stocks that are out there, and if you look through all of your investments, you might have some stocks that are sitting there that are going to be a capital gain if you sell them. You could have other stocks that are going to be a capital loss if you sell them. There is what's called loss harvesting, which is where you go through and you look at every single stock that you own, and you pick out all the ones that are losing, that you paid more for them than they're worth today, and you just, before December 31, you just sell all the ones that have losses. You can deduct up to $3,000 of capital losses every year. You can't go more than that unless you're offsetting capital gain with it, but that's a good way just to reduce your income a little bit. And then if you really like those investments, you can wait 30 days and buy them all back. There is a rule that you can't sell them on December 31st and buy them on January 2nd and deduct the losses. You have to wait at least 30 days before you rebuy that investment. But that is another really, really, really great way. Some other things that, it's not necessarily an end of the year tax planning, but, are you in, is your business organized the most tax beneficial way? Do you have the right type of organization? If you're a sole proprietor, would you benefit by being taxed, by being an LLC that's taxed as an S corporation? If you are a C corporation, does it make sense for you to be a C corporation? Should you maybe consider electing S corporation status? Those are decisions that can be made at any time. It's not necessarily end of the year, but they're decisions that the sooner you make them, the sooner you start getting the benefit from making that decision. So
now, Darren, can I ask you something on that? So
sure.
A lot of times childcare owners, they start out with one type of corporation, but as their business grows, they expand, they shouldn't always assume that what they start with should be what they end with. And like, should they consult with a CPA or a tax professional and maybe a tax attorney? Who should you consult with? What corporation you should have?
Yeah, well, that would definitely be your tax preparer, your CPA, if you're using an attorney to prepare your taxes, but really somebody that understands and will give you the right answer. And if it doesn't seem like you're getting the right answer, it certainly doesn't hurt to ask that question of somebody else. Can you, and it's a simple question. Can you do an analysis and tell me if I have the best type of entity, to limit or minimize my taxes? We all, unfortunately, we all have to pay taxes if we make income. But if you make $1 million and pay $300,000 in taxes, that's better than making $1 million and paying $500,000 in taxes. So having the right entity can make a huge difference. And another thing that you can do is establishing a pension plan for your business. And again, there's always some cost involved with establishing a pension plan, both the cost of establishing the plan and the cost of benefits that your employees will get out of it. But it can actually work out where you can make contributions on behalf of your employees to the pension plan, make contributions for yourself to the pension plan. Maybe that's in lieu of giving out raises. Maybe that's, you give small raises and establish a pension plan. It's a benefit that your employees are getting, but it also, greatly reduces your taxable income. And maximizing the amount that you contribute to your own pension plan, maximizing the amount you contribute to an HSA plan if you have one, all of those types of things. And again, for people who are, if you are a pass-through entity, all of those things also, with your spouse, if you have an outside job, maximizing what you contribute to a 401k, to an HSA. What HSA is a health savings account, which a lot of people have when they have a high deductible health insurance plan. So those are all great methods to reduce your taxes. And then, of course, the big one, which a lot of people talk about, but I don't think a lot of people really understand or fully comprehend, is the SALT workaround. Have you heard of that? I mean, you probably don't know a lot about it because they don't have it yet in Maine.
They don't have it in Maine, but I've heard you talk about it before. I remember you mentioned it in the Jamaica conference we had, but it does affect several of our members. So if you want to do a quick talk about the SALT workaround, it'd be great.
Sure. So the SALT workaround is basically a response to the Tax Cut and Jobs Act changes that happened in 2016, where they placed a limit on on the amount that you can deduct in your personal itemized deductions for your state and local income taxes. So when you add up real estate taxes that you pay on your personal residence and any second home that you might have, all of your income taxes that you pay, your taxes to register vehicles, any personal property tax that you pay, all of those, easily, a lot of business owners are paying $100,000 or more in those taxes. And the TCJA, the Tax Cuts Act, limited those deductions to $10,000. So even though you pay $100,000, you only get to deduct 10. And that's part of your itemized deductions, which everyone, hopefully everybody knows. You either get to take your standard deduction, which is 26,000, 28,000, whatever it is. I never keep those in my head because they change every year. So you can take that deduction, it's a free deduction that everybody gets, or you can take the total of all of your itemized deductions. So when you add up your $10,000 for state and local taxes, plus whatever you pay in interest on your home mortgage, plus whatever you do for charity, if it exceeds that $26,000 number, you get to deduct that instead of the 26. So really, until you get past past the standard deduction, you're not gaining anything for that money that you've paid out. So what happened was several, and especially the states with high state income tax, California, New York, those states came back and said, our residents are getting killed by this. They're paying all this state income tax and they can't deduct it on their federal tax return. And it's not right. So they essentially came up with what's called a SALT workaround, where typically if you have a pass-through entity like an S corporation or a partnership, or LLC tax is one of those, all of your business income flows through to your personal tax return, and it's just another line item on your personal tax return, and then you calculate your tax and you pay your tax, and you do the same thing on your state tax return. So what the SALT tax workaround does is it says you make an election at the entity level to pay tax on the business income for the state taxes. So you elect to pay all of your state income taxes at the entity level. You pay those taxes, and then when you file your personal tax return, all that money that flows through on your federal return is reduced by the state income taxes that you paid. So if you make $1 million with your business, and your state tax on that is, let's just say, $100,000. Instead of $1 million flowing through to your tax return, your federal tax return, you would only have $900,000 flowing through to your federal tax return. So you're basically paying tax on $100,000 less at the federal level. And then on your state tax return, that $900,000 doesn't even come in. It's excluded from your state return because your tax was already paid at the entity level. So essentially, if you're in a 35% tax bracket, you save $35,000 by doing this. So there's a lot of pitfalls. There's a lot of reasons why for some folks this doesn't work. But a lot of folks, it's a great tax savings strategy. It doesn't really cost anything except for a little bit of extra work from your CPA. So, your CPA might charge you, a few hundred, maybe even $1,000 more because of this, but save you 30, 35, 50. I mean, who knows how much money you'll end up saving. But again, there are pitfalls. There are times when you could do this and end up paying more tax because you made this election. And so everybody has to do this on an individual level. Everybody needs to have an analysis done of it. So I would just recommend talk to your CPA. Does it make sense for me to use the SALT workaround, in my state? There's I think 9 states that have no state income tax. Some states of the ones that do have state income tax don't have a SALT tax workaround. Your state legislature has to enact a SALT workaround in order for you to be able to do this. And I know there's a handful of states, Maine being one of them, that still hasn't enacted a SALT workaround. But if your state has one, your CPA should be able to do an analysis for you and tell you if this will be beneficial to you or not beneficial to you. And every state is different. Some states you have to make a decision and you have to file your intention to do that by December 31. In some states you have up until the due date of the tax return. But the important thing is, if you are a cash basis taxpayer, you need to pay the state income tax by December 31st, or it does not get you any benefit until 2024.
Interesting.
So it's one of those things that you really should be talking to your CPA about right now. If you aren't already doing it. And I've seen people who they've asked me, should I be taking advantage of this? And I look at their tax returns and they already are. And they don't even know it because their CPA has looked at it and made the determination that they should be doing this, that it's going to be beneficial, and they've just done it for them, and the people don't even realize that their CPA did it for them. So it's certainly something that you should be out there and discussing with your CPA, and it could very well be that your CPA is like, yeah, we're already doing that.
Nice. Well, I mean, knowledge is power. So the more knowledge you know,
Right.
the more prepared you are and the less taxes you'll pay.
Right. And the other thing that I would encourage, everybody, ask your CPA questions. Do not be afraid to ask a question. Don't be afraid of sounding stupid. Don't be afraid of asking a silly question that the CPA, gives you the answer. Well, yeah, we're already doing that. It's the old thing, nothing ventured, nothing gained. I mean, you have nothing to lose by asking the question, and you have a lot to lose by not asking it if it's applicable.
For sure. Darren, anything coming in 2024 that we need to know about? Any proposed tax changes or anything?
Well, the biggest thing that is going to impact almost every small business owner is what's called beneficial owner information reporting. And this, it has nothing to do with taxes, but it's one thing that kind of ends up falling on CPAs a lot, or I think will. And this is a requirement that basically it was enacted, I think, in 2021 or 2022. And basically it's an attempt to crack down on terrorist organizations and criminal activity that is using LLCs and S corporations and LLCs and S corporations, essentially as a way of hiding, collecting income and not having anybody know who's actually getting that. So a terrorist organization, rather than coming in and a known terrorist sets up a business and starts collecting money, comes in and forms an LLC in a state where there's privacy. There are states where you can form an LLC and nobody knows who owns the LLC. So the federal government basically passed this law that says that every single owner of an S corporation, an LLC, or small closely held C corp, has to file a report with what's called FinCEN. It's a federal agency, and you have to file a report that discloses who the beneficial owners are of your business. And that is every single LLC, every single S corp. There are like 23 types of entities that are excluded, but for the most part, small businesses have this reporting requirement, and it is a hefty fine for not reporting. So $500 per day for not reporting information that's required. Now,
when's it due, Darren? When does it due to get in?
So it is, if you are already incorporated, or if your organization has already been formed prior to January 1, 2024, you have to report prior to January 1 of 2025. So basically December 31 of 2024 is your deadline for filing. You must, any new entity that comes along, so if you create a new entity January 3rd of 2024, you have 30 days to file your report, your beneficial owner information report.
Wow.
So, it's as simple as I know some people buy a new building and they create an LLC to put the building in, and they're not necessarily always talking with their CPA when they do this. So it's really important to understand that if you go create an LLC to buy a building, you have to file a beneficial owner information report prior or within 30 days of creating that LLC. And so again, if you're already in existence, you have until December 31, 2024. If you're new, created in 2024, you have 30 days from the date the entity is created to file this report. And once you file your initial report, if there is any change in any change in ownership information, any change in the address of an owner, you have to file a supplemental report within 30 days. So it is a huge reporting requirement, especially if you get a business with 4 or 5 owners, the management of that business has to be on top of one of the owners moved. We've got to file a supplemental report and change that address. And the penalty, I am in hopes that penalty was just put out there for them to go after, folks who they know are some sort of criminal activity going on and they haven't done the report. They're gonna whack them with this penalty, and that, someone like you, if you move and forget to file this report, they're not going to come at you and charge you a significant penalty. But again, why take that chance? Why not just stay on top of it and do all your reporting as it's required? So beneficial owner information reporting, that's something that's new, that's a significant impact. And, it's causing some angst from some people who, there are people who have gone to great lengths. They just don't want anybody to know who owns their entities. And, because of this, it's supposed to be private. The IRS or the federal government is supposed to get this information, and it's not going to be public information that's shared with anybody else, but they have it in the event they need it. So it's depending on who you are and what your thoughts are, it's either just a big burden on small businesses, or it's a giant overreach, of government intrusion into your privacy, or whatever you want to consider it as. It's something that's out there. It's something that we have to pay attention to, and we have to make sure that we stay on top of it.
Well, since Carol and I own 19 LLCs and 3 S corporations, sounds like we got a lot of work cut out for us filling out these darn forms. But I'm so glad to have you on. I mean, a lot of our clients and a lot of our followers have LLCs for the properties that they own, different businesses, multiple businesses in some cases. So this was educational. Do we know a form number yet of this thing, Darren, from the IRS?
No, it's actually a form that you will fill this form out online. It is it's not even live yet. It goes live January 1, 2024. So right now, I don't even think you can get to the website, but I can get that website. What I'll do is I'll email that website to you, and you can share it with everyone. It will go live, and it's basically, I have no idea how involved the form is, but I know it's going to ask for the entity information and for name and address, and I'm not sure if it's taking social security numbers. I have no idea what it's going to ask for, but it's going to ask for all of the information for each beneficial owner. And that it will get very tricky, especially if you have multiple layered entities. If you have this entity is owned by this entity and it's owned by this entity, and if you have multiple owners in the entity, you've got to figure out who the ultimate beneficial owner of each company is and what percentage they own of the company. So for some larger entities, with layers and multiple owners and different owners at different levels, it's going to be a significant amount of work.
Interesting. Well, that was very educational. Just to recap, so get those expenses claimed in 2023 to reverse that tax burden. He talked about prepaying expenses. If you're planning on going to a conference in 2024, buy those tickets before the end of the year, get those hotel rooms paid for. Think about things that you would spend money in maybe in early 2024, like even food, daycare food. If there's something you can, canned goods or anything like that, buy a couple months worth, stock up on some cleaning supplies, get those purchased before the end of the year. I know we always do that. Something you're going to buy in January, February anyway. Get some stock up on some of those some cleaning supplies and products and curriculum, prepay for your curriculum, prepay for coaching programs, something that you're going to spend money on in 2024 anyway. Get the expenses, reduce that burden. It pushes higher income in 2024, but you'll have less grants money. And overall, I think you'll probably do better financially for most people. Would you agree?
Yeah. And that's always the thing that I stress to people is we want to always, if you're in a year where your income is high, we want to pull in more deductions, defer income. If you're in a year where your income is down and you're in a lower tax bracket, then in that year, we would just as soon take advantage of that low tax bracket, pay the tax at 12%, pay the tax at 22%. Because what that's going to mean is you're going to have that deduction in the following year when your tax bracket might be 32% or 34% or whatever it's going to be. And you take that deduction to save, a $10,000 deduction in a year where you're at a 12% bracket, it's only $1,200. Whereas if you have it the following year, if you're in the 32% bracket, you're going to save $3,200 by having that deduction in the following year. So it would make no sense to pull it from a 32% tax bracket year into a year where you're only paying 12%. If, for whatever reason, you've had some significant loss. So be at least cognizant of where you are in the tax brackets, and is your income high or lower, wherever. Some people are pretty much, they're always in the 30, in the top bracket, no matter what's going on. They're looking at a difference between 3 million and 2 million, and you're in the top bracket anyways. But if you're one of those folks that you're looking at a difference between 300,000, 500,000, it can make a huge difference for you. Which year you put that deduction into.
Awesome. Well, this has been educational. I learned a few things, and I'm excited to get the end 2023 behind me. I'm not looking forward to all those 22 different forms I got to fill out for the federal government. But I do understand why they do it, so I won't complain too much. I know a lot of people, especially criminal organizations, try to hide money through shell corporations, politicians, and bad people and criminals hide money. So yeah, they can go find that money. Maybe they'll stay away from us middle class business owners if they go after the top guys. So that might make me happy.
Let's keep our fingers crossed on that one, Brian.
Yeah, that's for sure. But if you don't cheat on your taxes, you probably have nothing to worry about, which I don't. So I'm not too worried. But anyway, thanks, Darren, for coming on the Childcare Genius podcast. I will put your email in our show notes. So if you need to reach out to Darren, you could do so that way. So hope you have a good rest of your day, buddy. And thanks for coming on the podcast.
Thanks. Always a pleasure. Have a good day.
Well, he always gives great advice, doesn't he? He's definitely knowledgeable. He's been doing he does a lot of childcare owners' tax returns, so he knows our business inside and out. We've educated him on the business for the last 25 years, so he knows our business. He knows the real estate business in depth too. Which before we buy a property, we always seek his advice. And we own a lot of property, which keeps him busy. We have a lot of phone calls discussing that strategy. So if you need help in your childcare business and you'd like a free coaching call with me, I'd be happy to get on a call with you. If you're a center owner, I'll see a center owner, and just go to childcaregenius.com and under the coaching tab, select I'd like a free coaching call. And you're guaranteed to come away with 2 or 3 different action items in any area that you could possibly struggle. So this concludes episode 69 of the Childcare Genius podcast. Thank you for taking time out of your busy life to spend a little time with us. And don't forget to hit that subscribe button so you won't miss a future episode of our podcast. And we will see you next week. Bye-bye.
Bye.
Thank you for listening to the Childcare Genius podcast. If you enjoyed the show, please do us a favor and hit the subscribe button so you don't miss a future episode. Don't forget to visit our website at childcaregenius.com to see a list of services we offer to help grow your childcare business. Until next time, thank you for being a part of the Childcare Genius community.